Another index is the U.S. small cap index. Small cap meaning small capitalization. These are the smaller companies, less than $1 billion in size. A little bit more volatile. Any guesses on what the U.S. small cap annualized return was for the 35 years, same 35-year period? 10 plus, 10, 11%. 11% annualized return. Now, after the market crash, a lot of people are thinking, when do I get back into the stock market? Do I need to get all my money back into the stock market? I'm attracted to it because it gives good returns, yet I'm a little repulsed by it because I lost 50% last year and I don't have anything else to spare. What a lot of people will recommend, and you hear this out there, is a diversified, balanced account. What does that mean? Well, this third question, what if you were to, say, put 60% of your portfolio into diversified stocks, diversified stock indexes, some international, some domestic, some large cap, some small cap. 60% into the stock market, 40% into the bond market. What would that return have been over the 35-year period from 1973 till 2008? Any guesses on that? Far less in the stock market than any of the two above. The return for the 35-year period, annualized rate of return, is 11%. I think most people's initial reaction is, I don't know that I want to buy bonds. I don't know if I want bonds in my portfolio because they don't give my 25 and 30 and 50% return that I'm so used to. And I would say, don't get caught up in the cocktail party chatter. I bought this and I sold this and I've doubled my money, and very few money managers out there beat the stock market indices. And the indices, you can see the indices, the index returns above. So 60% diversified stocks, 40% in bonds, you would have achieved an 11% annualized return. So then next question is, how many years would I have in a 35-year period in the past? How many years would have been what we call losing years? I lost money rather than made money. Any guesses on the S&P 500? If you had bought the S&P 500 and held it for 35 years, how many of those individual years would have been losing years? Guesses? 8? 9. Split these guys right down the middle. 9 years. Out of 35, there were 9 losing years. For the U.S. small cap index, how many losing years? Out of 35 years, there were 11 losing years for the small cap index. And now we go back to the diversified portfolio. Slightly over half the money in stocks, slightly under half in bonds. How many losing years of 35 years would I have had? You would have had 5 losing years. So you have a portfolio that historically returns the same as a small cap stock index and has less than half the number of losing years that the small cap index has. The last 3, the S&P 500. What was the worst year from 1973 through and including 2008? Any guesses what year that was? The very worst year for the S&P 500, that was 2008. The S&P 500 lost 37%. 37%. The small cap, the U.S. small cap index, the worst year it ever had, was also 2008. And that lost 38.6%. The diversified portfolio, the worst year ever in that 35-year history, was 2008. And it lost 24.1%. So the intuitive thinking that by buying a lower returning instrument, I'm going to affect my portfolio in a negative way is untrue. By buying bonds and keeping a balanced portfolio and not getting talked into the put all your money in the market and pull it all out, put it all in, by running a diversified portfolio balanced between stocks and bonds, historically you will match the return of a small cap index. You will have fewer down years, and the down years will be far less severe than if you were to hold stocks only.